Two brothers inherit the same amount of money, $40,000 each, same age, same source. 5 years later, one has nothing left and a car payment he regrets. The other has $71,000 because he invested most of it and let it sit. Same parents, same starting line. What changed? The first brother didn't do anything reckless. No casino, no embarrassing purchase. He moved to a nicer apartment, traded in a fine car for one that felt like him, replaced a laptop that still worked, took 2 extra trips. Piece by piece, $40,000 turned into a slightly upgraded version of the life he already had. The second brother did something almost boring. Same apartment, same car, same routine. He just refused to let the money touch any of it. It went somewhere else entirely, and he barely noticed it leave. That's the whole story of minimalist money management told through one family. It was never really about income, or even about the $40,000 itself. It's about whether new money gets absorbed into a life or redirected past it. 7 rules decide which brother you become. Let's start with the one that made all the difference for the second one. Economists have a name for what happened to the first brother: lifestyle absorption. Any bump in resources, a raise, a bonus, a windfall, quietly gets swallowed by upgrades until it disappears. Nobody decides this on purpose. It happens in small, defensible choices. The raise lands, and the $60 dinner suddenly feels earned instead of excessive. The bonus lands, and the flight upgrade feels justified. Each choice looks fine in isolation. Stacked together, they raise your spending ceiling at exactly the same rate as your income. A study of lottery winners found something telling. People who won $50,000 to $150,000 ended up barely better off long term than winners who took home under $10,000. The money didn't fail. It just got folded into a bigger life instead of a different one. So decide where new income goes before it lands, not after you've had a month to get used to having it. Whatever you don't assign a job, your habits will claim for you. A price tag tells you what something costs to acquire. Almost nothing tells you what it costs to keep, and that's not an accident. Nobody selling you something wants you thinking about the second bill. Compare an espresso machine used most mornings for years to a stand mixer bought during a baking phase and used 4 times a year. The machine's cost spread across every use is basically nothing. The mixer is renting cabinet space you're paying for either way, adding a small tax of friction every time you move it aside, and quietly generating guilt every time you see it. Before any purchase over roughly $100, ask what it costs to keep, not just to buy. Storage has a dollar value. Upkeep has a dollar value. Attention has a dollar value most people never price at all, even though split attention is one of the most underrated costs in personal finance. Cheap things can be expensive to own. Expensive things, used constantly, can be nearly free per year. The sticker price is a bad predictor. Usage is the only honest one. Most people default to yes on spending and have to talk themselves out of a purchase. The financially stable ones flip that. They default to no and have to talk themselves into one. That sounds like a small flip. It isn't. It changes who carries the burden of proof. Default yes means every purchase gets approved, unless you catch yourself in the moment, which takes energy and self-control. Right when your brain is flooded with wanting the thing, you'll lose that fight often because willpower runs out, and marketers are counting on it. Default no means a purchase only happens if you can name a real reason for it. That takes almost no willpower. because doing nothing is the easy path. You're not resisting temptation mid-swing. You built the system, so temptation has to make its case first. Treat every non-essential purchase as rejected until proven necessary, not accepted until proven excessive. It's the single highest leverage mental shift in this video. Complicated budgets don't fail because they're wrong. They fail because they're exhausting. Sorting 40 transactions into 12 categories every week is the kind of task that gets quietly abandoned the first busy month. Not from laziness, just fatigue. Replace the whole apparatus with one figure, the gap. Income minus expenses, checked weekly. Not 17 labels, not a color-coded sheet. One number showing whether the space between what you earn and what you spend is growing or shrinking. This works because the gap is the only figure that actually decides your trajectory. Overspend on groceries, underspend on takeout, it doesn't matter, as long as more is landing on the saving side than the spending side. And the trend keeps improving. A 5-minute weekly check survives for years. An hour-long daily breakdown survives about 3 weeks. Set a threshold, $50, $100, whatever fits your income. Above it, ask 2 questions in order. 1, will I still want this in a week? This catches impulse buying driven by boredom, stress, or a well-designed checkout page. Most urges that feel pressing in the moment are gone within days if you just wait them out. 2, only if the first answer was yes. Do I already own something that does 80% of this job? This catches redundant upgrades. The third knife, the second pair of running shoes, the better version of something that already worked. Most people own something close enough already. The remaining 20% rarely earns the full price of duplication. 15 seconds of thought and most temptation purchases never make it past the second question. Not all debt behaves the same, so treat it the way an emergency room treats patients. Some are bleeding out, some are stable. High interest debt, credit cards, most personal loans, anything above roughly 15% is the bleeding patient. Handle it first, before investing, before anything else on this list. A 22% balance is a guaranteed 22% loss, compounding daily. Nothing reliably beats that return, so paying it down is the highest return move available. Low interest debt, a reasonable mortgage, some student loans, a car loan under 7% is stable. It doesn't need emergency treatment. Throwing every spare dollar at a 4% mortgage while skipping investing is often the weaker trade, since markets have historically outpaced that rate over time. The common mistake isn't carrying debt, it's treating all debt the same, panicking over a manageable mortgage while quietly bleeding out from a credit card. Sort by urgency first, then act. The real finish line rarely gets stated plainly. It's not a big number in an account. It's how many months you could go without earning anything at all. Call it runway. Take your essential monthly expenses, the trimmed down version, not your current spending, and divide your accessible savings by that figure. The result is how long you could survive with zero income before real trouble starts. This number outweighs net worth, outweighs income, outweighs almost everything else in personal finance, because it determines whether you can say no to a bad job, a bad boss, a bad situation. 2 months of runway means tolerating nearly anything to protect the paycheck. 12 months means walking away from something that's genuinely wrong for you. That's not comfort. That's a different relationship with your own life. Prioritize extending this figure above nearly every other financial goal. Each added month is real, usable freedom, not a hypothetical one. Back to the brothers, same inheritance, same start, 5 years apart in outcome. The gap wasn't willpower in the way people usually picture it, gritting your teeth past every temptation. It was structural. One let new money default into his existing life. The other gave it a job before habit could claim it. That's the whole philosophy in one line. Minimalism isn't about wanting less. It's about making sure what you already have, money, space, attention, is going somewhere on purpose, instead of dissolving into a life that's just a little nicer than yesterday. Assign new money a job before it lands. Price the keeping, not just the buying. Default to no. Track one number. Ask two questions. Sort debt by urgency. Build runway. None of it needs more income than you already have. It needs a decision about where the money goes. Made on purpose instead of discovered a year later. Now, I have a question for you. How many months of runway do you have right now? Comment below.